What a day, what a day, what a day. The IPO markets are open, you guys. Netskope has filed their S1 to go public on the old NASDAQ. Woo! They're clocking in at 707 million in ARR, over 600 million in GAAP revenue, growing plus 30% year over year. And this is a cool security story. We're going to dig in. I took more time than I like to admit reading their S1. I did not put it to AI. I actually read this thing, all like 300 pages, multiple times. After we get a quick word from the fine folks over at Campfire. You may know that we use Campfire as our ERP at my company, Mostly Media, and it's been a game changer for our finance workflow, coming from the guy who does it all. The interface is intuitive, migration was quick and painless, and it's freed me up to focus on strategic work instead of manual processes, like, making content for you. In case you don't know, Campfire is an AI-first ERP powering next-gen finance and accounting teams. They help you close fast, unlock insights, and scale smarter. Seriously, the metrics and P&L views that I'm pumping out of the system are nuts. And you can tell this thing is scalable for companies who have multiple entities, complex department hierarchies, and various product lines. I haven't gone international yet. Well, I am going to London next week, but I do have 2 newsletters and a podcast to track. If you're curious about where finance tech is heading, I am, and would like to hear more of my thoughts on the topic, don't miss Campfire's Finance Forward AI Summit, the upcoming summit bringing together the sharpest minds in finance and operations. You'll hear directly from industry leaders on how they're using AI to shape the future of finance and how your team can get ahead of that curve. I'll be speaking on panels with finance leaders from Anthropic, Snowflake, Mercury, and more. The summit is October 28th in San Francisco. I hope to see you there. Sign up for the summit at campfiresummit.ai or learn more about Campfire at www.campfire.ai. All right, folks, let's get into it. Netskope's IPO S1 breakdown, okay? So, like I said, 707 million in ARR. Over 85% of their ARR is from big customers, spending over $100,000 per year. Their net dollar retention as of July clocking in at 118%. That's powerful because, they could hypothetically go on vacation for a year and still grow 18%, embedding growth into their business model. They have over 170 million in losses, though, in the first half of 2026. And they did have a tiny bit of positive operating cash flow in the first half of the year. These companies, if they have ARR, will usually cite the biggest number. That's their run rate exit as of the period, which is 707 million, which is plus 33% year over year growth. The 616 million in trailing 12-month revenue represented 31% growth. Customers clocked in at 4,300, which grew at 21%, which means that they are increasing the amount of revenue they're getting per customer, with the revenue growing faster. And that includes 30% of the Fortune 100, 18% of the Global 2000. Many people may say, well, are they only selling to like Series B CTOs? Like, no, their ICP is actually a public company CIO. Speaking of big customers, 111 of them are spending over $1 million a year. That's important there. So 111 customers spending over $1 million a year. I believe when Rubrik went public last year, they had 99, and I was joking like, oh, you couldn't get one more there. But there will be a lot of comps to Rubrik, and you can see why they would be excited to go out, because Rubrik stock as of right now is up like 175% since going out, and they too were burning cash. They do have one customer that makes up about 3% of their revenue. Maybe it's somebody listening. They didn't tell me who. Their adjusted gross margin after you strip out stock-based comp was 72%. And I have to admit, that's pretty clean for a company with its own infrastructure. But at the same time, it indicates that AI incorporation may not be all that high since it would demolish your gross margin. It made me think, like, isn't it funny that we live in an era where you're simultaneously supposed to have scalable SaaS-like gross margins of plus 85%, but like also you're more fundable if your gross margins totally suck because your AI usage is so high. So just something that keeps me up at night. Like, what do you want from me here? Net loss, 170 million in the first half of 2026. They are in fiscal year 2026, which improved from 223 million in total losses last year. So still losing money, but at least headed in the right direction, kind of. Operating cash flow, 9 million positive in the first half of 2026. It's the first time they've ever been in the green, like anywhere. So you have to say, like, could this be real? Could it just be like some IPO window dressing? Did they just pay AWS 10 days late so they could file this? Headcount is approaching 3,000. And so they've more than doubled the people who work there in the last 2 years. Their revenue per head it's not great. It's 210,000, which is about half what you'd want to see when comparing to public peers who should be over 400,000. Capital raised to date 1.4 billion in primary, and they have a long list of later stage crossover folks like Lightspeed, Iconic, and Accel. And the high watermark for this one, folks, is going to be 7.5 billion, which was what they raised at in 2021 when it was pretty easy to cat call for some dollars back then. But this IPO will validate if that number still holds water or not. So what does Netskope do? I'm going to try to explain this to myself like I am a 5-year-old child because I'm not a technical expert. But from my understanding, they sell cloud-based security software that helps large enterprises protect data, applications, and users across their network, whether those users are in an office, on Wi-Fi, or torching through LTE on their phone in a hotel lobby. So they're kind of like the security guard for the data that passes through your network, no matter what device you're using or where you're located. In their core platform, Netskope One, it bundles together a bunch of acronyms that security teams care about, something called SASE, SASE, Security Access Service Edge, SSE, Security Service Edge, and CASB, Cloud Access Security Broker, and something called ZTNA. I'm not even going to try to do it. Nah, I'll do it. Zero Trust Network Access, and SWG Secure Web Gateway. So you get the idea. A lot of acronyms. That means there's a lot of security stuff going on in this platform. And so the pitch is that everything's like converged into one platform. Fewer vendors to manage, fewer bills to pay, and better visibility across endpoints, cloud apps, and SaaS environments. And really, that's something that both CIOs and CFOs can get behind, right? Fewer vendors. They also operate their own infrastructure. It's called New Edge with 120 data centers in 75 regions. And that's a fancy way of saying that they don't have to just piggyback on like GCP or AWS when it comes to network delivery. It's not cheap. You have to put up data centers, but it gives them more control over performance and uptime. And they had this pretty wild map of all their data centers across the globe. And so like to me, it's like how they even have a gross margin is nuts with the international data center footprint that they have. And of course, there's an AI angle. Netskope is training its own large language models on anonymized customer data to detect threats faster. And if I'm being honest, so far that shows up more in the pitch deck than the P&L. So 5 key themes in this IPO. The first is their strong land and expand motion. So with 118% NDR and over 85% of ARR coming from $100,000 or greater customers, their upsell engine is clearly working. And that's a great sign for long-term profit margin expansion, even if gross margins are closer to infrastructure like a Snowflake than a security SaaS provider. Why this matters is institutional buyers want to see a mature go-to-market engine paired with a sticky platform that produces multi-product attach, right? How many customers do you have on more than one product? And all things equal, they have 18% year-on-year growth embedded into their business model without having to acquire net new customers. So they had a really cute chart of customers with 3+ products, customers with 4+ products, and customers with 5+ products. They actually have 35% of their customers on 5+ products. They do have a crowded field of competitors with public comparables. Netskope goes head to head with the likes of Zscaler, Palo Alto, Fortinet, and increasingly Cisco. Remember them? Each competitor has scale, brand reputation, and their own platform play. So differentiating on performance and AI will be key. And this matters because investors are immediately going to compare Netskope's valuation, growth, and burn profile to Rubrik, who recently IPO'd, Zscaler, who's trading at a 15x forward revenue multiple, and Palo Alto, who has multi-product domination, right? Like they can sell you everything and a toaster. And so there's no shortage of high performers to gauge their progress against. Cisco be like the Undertaker rising from the dead. They're quietly decreasing sales and marketing as a percentage of revenue. So looking at the last 6-month period, sales and marketing dropped from 60% of revenue to 45% without a hit to growth. And that's a sign that they've found some go-to-market efficiency, likely due to scale and channel leverage. In absolute terms, sales and marketing costs only grew 7% year on year, while GAAP revenue grew 31%, which is awesome leverage. And total S&M dollars spent actually decreased when you compare to the most recent 6-month period to that in the prior year. The next theme is that they have an extremely people-heavy model. So I broke down what their headcount is and how it's changed over time. If you went back to FY 2022, around the time that they got that high valuation, or about a year after that, they were at 1,354 people. They are now close to 3,000, okay? And the headcount growth is keeping up with and has historically actually outpaced their revenue growth. They've more than doubled staff over the last 2 years as they throw more engineers at the product roadmap to retrofit their AI story and field sales reps to scale their international revenue base. They're very much a security company born in the 2010s, applying the field sales, cloud-based reseller, enterprise SaaS playbook. And this matters because they're not going to be breaking any world records when it comes to doing more with less people. Their revenue per head is closer to Series C or D levels than it is to that of a public company. And so if we went all the way back to January of 2022, they were clocking at 185,000 per head. They are only at 210,000 per head today, so largely flat over the last 3+ years. They have an extremely strong international revenue mix. So 41% of revenue comes from outside the US, which is unusually high for a security company that's still sub 1 billion in scale. And much of this is already routed through their global new edge infrastructure. So it's not just hyperscaler data centers. And this matters because it suggests that Netskope may actually be ahead of rivals in building a true global go-to-market, and it justifies infrastructure spend more than initially assumed. So how do they make money? Netskope sells software subscriptions. Contracts are typically multi-year, price per user, and sold top-down into large enterprises. And this is a classic field sales motion that's supercharged through the channel. It's not a PLG tool you can swipe a credit card for. And so they said in their S1, quote, "We generate substantially all of our revenue from the sale of cloud subscription to our Netskope One platform. We generally price our subscription based on the scale of the customer's organization and products deployed. A substantial majority of our customers purchase subscriptions with a contract term of 1 to 3 years. We recognize revenue from our subscription ratably over the term of the subscription. Our go-to-market strategy is focused on acquiring new customers and driving increased adoption of our platform from existing customers." And so revenue breaks down into 2 buckets: subscription revenue, which is about 99% of the total, and this includes access to the Netskope One platform and all the security modules bundled into it. And then professional services, which is like 1%, maybe 2 or 3% in certain quarters. And it's mostly tied to implementation and setup work. It's not material and not margin friendly, but it's a necessary evil, right? And so they say in the S1, our business and growth depend in part on the success of our relationships with our partner ecosystem. If we are unable to maintain or develop these relationships, our business results or operations and financial condition could be materially and adversely affected, right? That's how they sling their product, through the channel. And this means most deals are brokered by partners, not direct account execs, AEs, although the reps still get paid handsomely to work with partners and usher deals over the finish line. It allows for global scale and access to juicy multinational CIO budgets, but it distances Netskope from end user feedback loops and pricing power. And so they say in the filing, sales through our top 5 partners and their affiliates in aggregate represented 32% of our revenue for fiscal 2024 and 33% of our revenue for fiscal 2025. So pricing itself is opaque. Netskope doesn't publicly share seat-based rate or clear SKU level packaging. That's normal in security, where every customer is quote unquote special and deals go through multiple levels of procurement approvals. Upsell, like we mentioned, is a huge lever. Their products are modular, which means once they land with 1 or 2 services, there's plenty of room to tack on more, like data loss prevention, zero trust access, or browser isolation. And they also charge more if you want traffic to run through their private new edge network. Think of it like a fast lane on the highway that you pay extra for. Speaking of that, if you see my wife, she has continually gone through the speed passes in New York and Connecticut, and we're using a Massachusetts fast pass, and I'm tired of paying fees. Netskope heavily leans on multi-year contracts, especially in the enterprise tier with upfront billings. However, they only recognize revenue ratably over time. And this leads to a disconnect between billings, momentum, and the GAAP revenue. And it also hides short-term fluctuations in customer expansion or churn. So I want to talk about their losses. Show me what them losses do. They say, quote, "We have a history of losses, anticipate increases in our operating expenses in the near term, and may not achieve or sustain profitability. If we cannot achieve and sustain profitability, our business results of operations and financial condition will be adversely affected." So burn. They lost 170 million in the first half of FY26. That's down from 223 million the year before. So yeah, progress, but still deep in the red. And the company did manage to eke out 9 million in positive operating cash flow, which is a first. It's also a little sus that it happened right before the IPO. So is it like real efficiency gains or just some well-timed invoicing? But either way, they'll need to prove it sticks. They've raised 1.4 billion in venture capital with the last round in 2021, valuing them at 7.5 billion. They're not exactly cash starved. They're sitting on 261 million as of July 31st in their bank accounts, but they're also not Nvidia levels of flush. Which brings us to the IPO. The CEO said that, he said the quiet part out loud here. They're not going public for capital. They're going public for awareness. The quote is, "Becoming a public company is not the destination, but rather another significant milestone on our journey, one that we hope will amplify awareness of our groundbreaking Netskope One platform. Our high win rate, our batting average, as I like to call it, speaks volumes about the platform's strength. Going public, in our view, is about getting us more at-bats and expanding our awareness, reach, and hence positive impact." That's their CEO. The translation is, we need the NASDAQ logo to win more big enterprise deals. And it's hard to knock the logic. Their closest comp to IPO recently, Rubrik, went public earlier this year and saw its stock rip 175% post-IPO. That probably did not go unnoticed. So let's talk some market dynamic stuff. They play in the SASE, like we said, Security Access Service Edge, and SSE, Security Service Edge markets, categories that were born in Gartner decks and now have real ass budgets behind them. Their main rivals are publicly traded heavyweights Zscaler, the OG of cloud security proxy, Strong and SWG and ZTNA, Palo Alto Networks, bundling everything and selling it to your boss's boss, Fortinet, more hardware heavy, but increasingly pushing SASE via its own infra, and Cisco, trying to buy its way into relevance with a secure access bundle. Netskope's pitch is they're more platformy than the point solution crowd, with broader coverage across the web, cloud, SaaS, and private apps, all running on their own infrastructure, New Edge. And that infra angle is a real differentiator, but it's really expensive. So unlike Zscaler, which leans on public cloud for delivery, Netskope owns the whole stack, more control, but more CapEx. They also throw some elbows around AI, talking about their homegrown models that analyze billions of events daily. But if we're being honest, it's still early days, and right now AI is more of a slide than a real revenue driver. So we'll see how that develops. The overall market tailwinds are strong. Security budgets are still growing, even when everything else is under scrutiny. And as companies shift from firewalls and closets to policies in the cloud, the SASE category is expected to cross 25 billion in TAM over the next few years, a lot bigger than I thought. But the flip side of a hot market is noise. Every legacy vendor is now claiming to offer SASE. Netskope will need to differentiate on performance, depth, and simplicity. Three things that don't always play nice together. And side note, you won't see CrowdStrike or Datadog in the CIO bake-offs here. They're adjacent, not competitive. CrowdStrike protects endpoints. Datadog monitors performance. Netskope's in the access and data protection. Let's go over the financials and some of the finer points here. So like we mentioned, revenue was 538 million in 2025, which is 33% year on year, and 616 million on a trailing 12-month basis. So slow down a bit in July to 31%. And at the same time, losses narrowed, with much of the lift coming from sales and marketing efficiencies. And G&A didn't increase nearly as much as you'd think it would in an IPO year. I'd expect a lot of that to show up below the line later, though. And NDR is at a high from the last 2 years. They broke it out as our gross margins and free cash flow. However, as we mentioned before, their revenue per head lags all public market peers. You'd expect them to be close to 400,000 per head, not around 200,000. I want to talk about their valuation and cap table next, because this is where the rubber hits the road. They last raised in 2021 at 7.5 billion, but when money was free and AI had retired from the 76ers 8 years prior, my favorite point guard. They've pulled in 1.4 billion in cash from a deep bench of crossover names: Iconic, Lightspeed, Accel, Sequoia, and SoftBank. And the S1 didn't list the target IPO price yet, but it's safe to assume that they're aiming to clear that 7.5 billion mark, even if just barely. Anything else would technically be a down round. So if we were to look at what others are trading at, the market median for the 144 companies that I track every Sunday in my newsletter, mostly metrics, they're trading at 5x forward revenue. That would put them, if they were growing next year, to around 740, 770 million in revenue, only like 3.5 to 4 billion. So I think they're going to be higher than that. Palo Alto is trading at 10x. That would put them somewhere in the 7.5 to 8 billion range. 15x Zscaler, 11 to 12 billion. 20x CrowdStrike, about 15 to 15.5 billion if they were able to get that. That would be premium. And Cloudflare's at 25x, Figma's at 30x. Sky's the limit, guys. And like we said, still had 261 million in cash in the books as of July 31st. So while some extra padding would be nice, this IPO isn't about just plugging a hole. They'll probably try to raise in the 500 million range, I'd estimate. It's about giving those early investors a path to liquidity and giving the sales team a new slide for the QBR with Bank XYZ on it. And speaking of that, banks Morgan Stanley and JP Morgan are leading the offering. Wondering how much of their new edge software they had to buy to be on the lead left. Other banks on the ticket: BMO, TD Cowen, Citizens, Mizuno, Wells. No slouches, but also no signal this will be a blockbuster float. We'll know more about that once they set a range, but given the current appetite for enterprise security stories and the fact that Netskope isn't bleeding cash like it used to, just kind of losing it, there's a decent shot that they price this thing in probably the 10 to 12 range. I don't know. Could it get up to 15? Who knows these days? Figma is trading at a bazillion. So I don't know. If Netskope prices at 7 billion or lower, though, participants in the 2021 round like Iconic, Lightspeed, Accel, Sequoia, Social Capital, Base, Sapphire, my goodness, this list goes on and on. They could have flat returns after 3 or 4 years of illiquidity and potentially negative IRRs once you factor in the time value and the dilution. The equity lockup. So Netskope is sitting on a mountain of unrecognized equity comp to employees. So if the IPO had priced on July 31st, they would have booked 316 million from RSUs tied to the IPO trigger. That's OpEx hit. A flood of stock-based comp expense that's going to weigh heavily on optics in the first quarter post-offering. So they've also adopted a new 2025 equity plan with an evergreen clause, which means the pool can expand annually without shareholder approval. A quiet lever for future dilution. And in a newly approved ESP, you've got plenty of runway for additional equity grants. So as for the lockup, it's typical 180 days for employees. A couple of red flags here. First one, the PIK debt could dilute common if IPO misses the mark. So Netskope is carrying 476 million in convertible senior PIK toggle notes. Wow, that is a tongue twister. Imagine if you had that on a bumper sticker. It's split across two tranches: 400 million at 3.75% due in 2028, 75 million at 3% due in 2029. And the PIK structure means they can opt to pay interest in more debt rather than cash, compounding the liability. And these notes convert into Class B shares, setting up future dilution risk, especially if the IPO underwhelms and the conversion math gets messy. So without clarity on conversion terms, the dilution risk remains uncertain, which is exactly the kind of ambiguity institutional investors will want spelled out during diligence. For example, will it convert at, I'm making it up, 20% discount if valuation doesn't clear, making it up 10 billion? You'd want to know that. 316 million of stock-based comp. What a bomb. About to hit the P&L post-IPO. As we mentioned, carrying a massive stock comp overhang tied to RSUs that vest once the IPO goes live. That's not just dilution. Like I said, it's a P&L crater. So just know that that's going to hit and make them look less profitable. And the last one here, the LTV to CAC, they cite a really big number. They throw out a 10x LTV to CAC, which would put them in the SaaS Hall of Fame, but feels overly optimistic. I mean, if you have it, flaunt it. But they remove all stock-based comp charges from these metrics, one of the key levers for their sales team. It looked like their CRO received nearly 10 million in equity grants last year. Should probably go in there. Any cost they put in there was adjusted. So the TLDR here: Netskope is a high-powered edge security platform of global scale, solid retention, and strong customer penetration. But expectations have to be managed. They got the PIK debt, the comp spike, and the opaque economics, and infrastructure costs muddy the profitability outlook. The IPO will test whether they've built the muscle to scale efficiently or just continue to add people to add revenue. Keep in mind, folks, none of this is investment advice. It's all for entertainment purposes. Thanks for rocking with me. And hey, markets are in full swing.